exciting times in the tech sector, and it seems like every week there's an innovation.
Given that marketing and advertising are always leading indicators of what's happening in the culture, there is something going on.
Important role entrepreneurs play in both creating jobs and preserving and enhancing national competitiveness.
Internet.
And it's been a
That's
great
an
week
important thing.
with the
It's to
president on
fund
Tuesday.
that content that gets
Pretty much
created.
the whole cabinet and
And to do it better.
Because I believe fundamentally that technology companies live and die for tech.
Technology and innovation have reshaped our economy and our lives at breathtaking speeds. America's been fighting to figure out how to tap
Hey, thank you.
new resources that we have. Google's helped to show us the way.
Mr. President, you do realize Google's a sponsor, so thank you for that. And thank you all for being here. Marissa, so glad you were able to find the trigger finger on some real M&A. Let's hope there's many more. Ariana, great to see you. Mr. Mayor, Steve, love what you're doing for the entrepreneurial and technology communities. Larry, take it easy on that voice. I'm so pleased that you're all here to help me welcome everyone, this incredible crowd of CEOs, to DMS13. And now I'd like to turn things over to my good friend to take it from here.
All right, well, I appreciate that intro.
Good luck, pal.
Thanks. I got it from
As Marissa said, don't fuck it up.
I'm pretty sure she said don't screw it up, but thanks.
I'm here for you.
Yeah, okay, you can go now. All right, great. Well, listen, everybody, welcome to DMS13. We are so excited to kick this off this year. We got, obviously, you know me, showman. So we now have big stage. We've got all of you here. This is going to be a fantastic day. I hope you got your beauty sleep because there's going to be a lot going on today. And we're so glad that you're all here. In fact, there are many conferences. You can go to a conference, really good ones, but there's only one DMS. And the way we do things here is a little different. If you've been here before, then you know what to expect. If you're new, this is different in the sense that most conferences have A-class, A-list people on stage, and then whoever can buy a ticket in the audience. We turn things around, invite CEOs. It's a true summit, so we focus more on the audience than necessarily on speakers. The day is very interactive. You will notice there's sort of steak and sizzle. This is the sizzle part, but the steak, the real meat of the conversation around critical issues in digital will take place in the breakout rooms. And they hold about 100 people each, pack in there. This is where we get to leverage the fact that we've got peer-to-peer CEO participation here at DMS. There will be 5 people at the front of the room, but there's no difference between those 5 and the other 95. So it will be a very interactive conversation and, of course, nonstop networking. We've set up one-on-ones, 180 of them or so, plus obviously serendipitous impromptu meetings, which you are obviously going to take advantage of. We've got everyone from A to Z and 300 CEOs in between. You add those to the 100 strategics and the 100 financial. We have 500 industry leaders from across the globe. I counted. We've got them from 5 continents. We're still working on Antarctica and South Africa, but we'll be there, I'm sure. So it's really the ecosystem, and that's the whole premise behind DMS, is get the ecosystem together and have a conversation. I would be remiss without mentioning that this is only possible due to the generous help of our sponsors, Google, our title sponsor, AOL, Microsoft, and Newstar, our platinum sponsors, Axiom, Collective, Evidon, Exalate, KPMG, MediaMath, MediaOcean, Sociomantic, Sumo, and X+1 at Gold, and all the silver and bronze sponsors of DMS. Thank you for your sponsorship. It makes this happen. We've got a very busy day, as I mentioned, steak and sizzle, so we are in this room 3 times. This morning session, we'll have some nice discussions with, we'll hear from Google, we'll have a conversation with Facebook and Twitter. Again, all the programming is oriented around what's useful for the entire ecosystem. Then we break, to late morning into the sessions. We do 2 of them, 1 hour long. You'll break at about 50 minutes, move on to the next session. Then we're back here for lunch, and we've got some very cool programming at lunch. Don't miss that. We'll be in this room for lunch in an overflow room right behind us. And then we are back into the afternoon to 2 breakout sessions, and here at the end of the day. And I will tell you that we've got so much fun in the afternoon. I'm sure you all have busy schedules, but after hearing a great chat from Microsoft, we have a secret, undisclosed fireside chat that you do not want to miss at 4:50. And then, of course, as always at DMS, we conclude the day with my latest comedy video. This year's, it's called Use Bitcoin, and it's going to go viral, let me tell you. So that's the day. It's very busy. If you haven't already, download the DMS app. It's available on all your devices. It gives you everything. Notice there are no printed schedules. You have everything you want. You can even communicate with people here on the app. So it's lots of utility to that. And don't forget to tweet. Our handle is DMS13. That's pound DMS13. That's pound DMS13. That's pound DMS13. You know what they say about advertising. I think I reached my frequency there. So you will hear this music as the interstitial, and that's when someone's about to come on stage, so if you can give us some of your attention when you hear them. And so, as I mentioned, DMS is really about bringing together the ecosystem. We've got supply and demand, if you will, which is sort of what Luma does. In fact, Luma's put together supply and demand quite a bit over the last couple years since we launched in 2010. And we're very happy about those client successes and a lot more on the way. I want to talk a little bit about exit math. Exits are critical, obviously, as a wealth-generating mechanism for entrepreneurs, but also it got importance in the ecosystem because it helps fuel VC returns, which then enables them to fund more companies and creates the whole cycle. So some thoughts about exit math. All across the spectrum of sizes. So if you think of this bar as enterprise value, there are 2 ways you can exit, either by M&A or IPO. Now, in IPO land, there's a certain size required in order to be a public company. And we would argue that there's a pretty bright line at $1 billion that if you're don't have $1 billion market cap, it's just hard the way the buy side is structured to get momentum and liquidity in the stock and get in the indexes. And so that's kind of important, although we have had companies across the spectrum in this sector go public. M&A, on the other hand, there are opportunities for successful exits at lower prices because, after all, it's just a function of dollars invested. So we have everything from the tech and team deals, like you've seen up until this week, Yahoo doing, at sort of, sub $50 million, to the sort of the capitulation deals where people decide, let's join parties, all the way up to the cash deals in the hundreds of millions and even the billions, with obviously Twitter being this week's big announcement. Now, as I mentioned, the formula for return is just dollars in versus dollars out. So like I said, you can have great returns early on the scale in M&A land. And what's interesting is that this is actually a bit deceiving because all of these logos are just the bigger deals, the ones that get talked about in the press. If you actually did a distribution of the 650 deals in digital media that have taken place in the last 5 years, it would look something like this. And that's only at 1/5 scale. So 82% of all deals in the last 5 years are under $150 million. Important considerations when you think about how much to finance and where your strategic roadmap goes. And speaking of strategics, obviously not only do the deals dissipate as you get bigger, but think about it, the buyer universe, yes, there we go, graphics, obviously shrinks as you get bigger. So, there are not that many buyers out there in the $1 billion plus category. We believe there will be more over time, but it's interesting to think of it in that light. And now I want to ask Brian to come on up. And what we're going to do is quickly go through what we call the state of the state. Okay, so we're going to do markets and trends. Here we go. First, markets. Well, we had Facebook. I'm going to do this quickly. Here we go. See, now visuals that go with the commentary. There's the pipeline of companies that are either preparing or may be preparing, we don't know, to go public. Here's the issue I mentioned in terms of the spectrum. So you've got SaaS companies, which public investors love. And remember, public investors like a simple story. They're really not that complex. They like a simple story where they've made money in the past, and they've made a ton of money in the SaaS space. Mixed bag over here in consumer media, but ad tech in the middle. Again, we will know the answer at the end of this year. We'll have at least 2, 3, maybe even 5 or 6 companies public. So we'll know what's going on. Which may explain why some of the private companies are in fact staying that way because of this question marks in the public markets. And if you were to look at M&A activity that's taken place in the in this digital media world, we're actually dipped pretty substantially. So coming out of the recession, we had a pickup in M&A activity, as you would expect. And last year, and this is M&A activity that we track on all the companies in the LumaScape. So of the 3,000 companies on the 8 supply-side LumaScapes that map all of the digital channels, this is all the M&A activity. So it has a substantial drop-off in 2012. And by the way, that low level of activity has continued in 2013. And as I mentioned, a good portion of these are taking place at the smaller end of the scale. So what do you need for M&A activity? Well, I would argue, let's see, there's 10 things. You need a stable economy. We got that. There's audio on this if we have it. You need a vibrant stock market. It's at an all-time high. You need low interest rates. Couldn't get any lower. High cash balances, again, record. Great corporate earnings. Healthy sector growth. My God, digital media is growing very, very rapidly. Recognition of an opportunity. We talk to the strategics. Let me tell you, they know that there's a huge opportunity, and yet the realization that there's capability gaps in their infrastructure that they need to fill, and a recognition that there's not a timely, organic solution, unless, of course, you're Amazon. So that, therefore, and the final thing is there's supply. There's availability of companies that are available. So if this is all the case, I guess the question is, where's the consolidation? Now, it's not like there's no consolidation. If you were to take a look at the LumaScapes and think about all the activity, again, in the last 5 years, it would look something like this. So there is some activity. And think about it. Consolidation can happen one of 2 ways, right? It can happen by M&A or failure. So in M&A land, we did an exercise where we looked at the LumaScape in 2010 and compared it to the LumaScape in 2012. And, the good news was, of the 200 independent companies in 2010, 53 of them got acquired. So that's 25% consolidation. Sounds pretty good on its face. 74 new ones popped up. And so, ladies and gentlemen, what we have in this sector is clearly a game of LumaScape whack-a-mole. More audio, please. Now, more audio, please. So the other way that it can happen is failure. Already this year, we've seen at least 4 companies close down. So in January, AdBright went out of business. In February, Quadrant One was shut down. Adify shuttered its doors in March. And Pulse 360 out of business in April. Ladies and gentlemen, this is what I call a good start. No offense to the investors, and Adify had a great exit before it got closed down. But seriously, there is a lot of companies in this space. We do like the innovation that's brought about by all that fragmentation. At the same time, we do need less logos. We need less companies. By the way, I'll say it, I don't think it's going to happen. Because, again, past practice shows that with the availability of cheap VC money, we're just going to see more companies all the time. So for my staff that focuses on the LumaScapes, good luck to you. They need more sleep. And, of course, the big news this week of Yahoo, buying Tumblr. I love everything about this deal, including the fact that we suggested it to Yahoo. But more on that later. It's fantastic for New York, it's fantastic for technology, and it's a real signal that hopefully there's a lot more to come, and I love the attitude. And it was termed a get cool deal because, Yahoo is getting cool. What, people have joked, what are they going to call it? Yahoobler? Yumbler? And then we thought, well, geez, I suppose in other industries you could have sort of get cool deals where a large incumbent buys a cool technology, new model to try and, get cool. Let's see. Let's take a look at a few other ones. In the auto sector, you could have Chrysler, right? Chrysler and Tesla. Let's see if we went to transportation, Deltuber. That could work. Or in financial services, how about Goldman Square? All right, maybe. And finally, my favorite, in telecom, AT&T and Twitter. What would their motto be? Free the bird. Got trapped in there. All right. Top 5 trends. We're going to rattle through these real quick. We think there's 5 key trends that we're going to talk about that are going to be important in digital media. Automation, multi-channel, content and commerce, mobile everything, and convergent TV and digital video. So in automation, you're familiar with the growth of RTB. It has gone off the charts. The early predictions that this would grow at 100+% growth rates have actually been low. We've seen phenomenal pickup in the sort of automation that's being brought to digital media buying. And we think that means that we're going to move. Automation and scale kind of go together as we move towards performance. You've got Yahoo and CPM land, Google and CPC land, and others, as Neil will talk about. And then Facebook, the real question is, where will they land? On one hand, they're sort of got high premium CPM, sort of TV replacement dollar-like ads, but they're also doing retargeting, which is growing quite well. So I think they've got a couple of different models. And ultimately here, the goal of this automated sort of media buying world will be to move advertising from a discretionary expense to a cost of goods sold, maybe even a revenue driver, right? Think about how search works. It's optimized to begin with. And if you think of it from an evolution perspective, we had hand-sold premium inventory. That's the big premium guys. Then we had the advent of hand-sold remnant inventory. Then came the programmatic guys bringing a lot of automation to media buying. And then finally, a more nascent and amorphous world I'll call native/social, for lack of a better term. And these guys are more content-oriented, in-stream type advertising. And what's interesting is that our premise is they're all nicely connected to commerce. Different marketer objectives, but nonetheless, if you were to focus on the automation, we believe that big companies will have to enable their premium inventory to be optimized with these more automated media buying. So in the early days, it was remnant, but I think we're moving into the premium stuff. Multi-channel.
Great, thanks, Terry. So Terry just talked about automation and programmatic being one of those. So in display, we've seen massive advances with the use of data, real-time targeting to target audiences. And what we've also seen, and so that channel's become fairly optimized in just a few years, just like search has become optimized, email. But what marketers want is they don't want to have just individual single channels, each optimized. They want to be able to run consistent messages across channels to the consumers. And the good news here is we see this happening already. The leaders in the space are already running cross-channel campaigns using data as the hub linking together these channels. But that's not the whole story. It's not just cross-channel. It's also integrating the customer touchpoints multi-stage. It's from advertising to the website to the sale and finally support and retention. And if you look at this in the classic purchase funnel, you have data that can link the various stages. But you really have 2 data sets. At the top end, you have cookie-based data. And that can link the top end of the funnel, the advertising, through to the web. And so you can have a more dynamic, personalized experience using a data management platform. You also have a separate set of data, and that's known users. It's names, it's emails, it's purchase history, managed in a classic CRM system. But what we haven't seen much of is a linkage between these 2 data sets. You've seen it in more low-volume applications like marketing automation. Eloqua, Marketo have done a great job of tracking the visitors to a site once they become known, linking those profiles and be able to send that rich profile to the sales automation system. But in the B2C world, we really haven't seen much of that. But the company to watch here, or a company to watch here, is Facebook. Because what does Facebook have? They really do have these two data sets. They have the cookie data, they have names and emails, and they are linking this information already. And one announcement that came out in the past year is Facebook's relationship with Axiom and Epsilon and Datalogix, where they're combining that third-party data with this capability here. And so now you're able to track advertising all the way through to the purchase, to the sale, and that's both online and offline. So we think that's a really exciting development and one to watch going forward. And so we're very excited about the cross-channel and multi-stage trend, and that's why we're excited about our new LumaScape, the Marketing Technologies LumaScape. This LumaScape, we had over 158,000 views and downloads in the first week. It was by far the fastest growing and most downloaded LumaScape in a short amount of time. It represents really two main areas. The bottom half is a website. Since a website is really an integration of a lot of different technologies together by the enterprise in order to manage, analyze, and optimize their sites. The top half are the systems that marketers use to run their business. And as for the multi-channel and multi-stage trends we see, it's really the companies on this that are providing the linkage. The top half of the website is the personalization and optimization layer. Those are the technologies that can enable, when a visitor hits the site for the first time, to provide that very dynamic, personalized experience. And then in the sales and marketing platform area, you have the marketing planning tools that can help allocate the spend among the channels, as well as the systems, the marketing automation and email providers that are coming together, like ExactTarget, their acquisition of Pardot. Silverpop has been doing this for a while, but applying the marketing automation to the B2C world.
Great. Content and commerce. So we, seen, in digital, consumer modality really, really matters, right? People are in different modes depending on what device they're utilizing, and the way marketers need to message to them also has to be different. We would argue that interruptive media is not native to digital, and by that I mean, let's assume that there's some great content that you want to feast your eyes on. Okay, for the ladies in the room, there we go. Ryan always helps. And now a marketer, an advertiser, sticks a big interruptive message in front of you. This is not a consumer-friendly experience. And remember, in digital, the consumer is in control. So whatever formats that we provide for them for our brand messaging, we have to do it in a consumer-friendly manner. Back in 2003, remember those annoying pop-ups you had to get rid of by finding a little red dot? Well, they're back. They're just called welcome screens. This is Business Insider, but Forbes, Wall Street Journal, everyone's doing them now. And again, not necessarily the most consumer-friendly version. And by the way, the button to turn it off is always less than 8-point font. And when you do get to the website, of course, there's banner blindness. If you were to heat map it, we just don't look at the ads. So we got companies that are sort of at that intersection of content and commerce, bringing together models like these examples with Refinery 29, and Thrillist, Daily Candy, that are much more geared towards the bottom of the funnel. If we go back to this slide, you'll notice the area down here, which is integrated to commerce. Obviously, the programmatic world integrates to commerce very well with retargeting. In this native/social world, it integrates to commerce a couple of different ways. There's the integrated models like Fab. If I said to you, is Fab a content company or a commerce company? The answer is yes. Or reviews like Bazaar Voice and Yelp. And I think this is going to become more and more interesting as the digital channel becomes more efficient for driving people to the bottom of the funnel. And of course, we saw the Yumbler transaction this week. Pay close attention to the Yahoo and Tumblr logos from this slide from 4 months ago. There we go, and there it is, and it's back, and there it is, and it's back. Okay, Marissa, I'll call you later for the commish. Mobile everything.
All right, great. So just talked about multi-channel, and in digital channels have been fairly siloed: search, display, social, video, and mobile. But mobile, is that really a channel? Well, we'd say no, it isn't. It really is a layer across all these other channels. It is mobile everything. You have mobile search, mobile display. Social is inherently more valuable because of the always-on nature of having your mobile device with you, and mobile video. So looking at each one of these, mobile search. Just back in end of 2011, mobile search, or search on mobile devices accounted for 12% of searches. 1 year later, that doubled to almost a quarter of all searches. And the benefit of this actually is accruing very much to Google. I mean, Google's desktop share is somewhere around 80%. Their mobile share is close to 90%. Mobile display. So if you look at a couple of the premium publishers, Yahoo, since Marissa got there, what has she been doing? She's done 10 acquisitions of mobile companies, really mobile acqui-hires, but it's really to beef up their mobile capabilities in order to become a mobile-first company. ESPN, they were one of the first premium publishers to embrace the mobile-first philosophy. And so when they design their sites, it's first for the iPhone, then the tablet, and then the larger screen. So it's completely flipped, web development on its head. Mobile social. So a year ago, when Facebook was about to go public, the main concern among investors was, what's their mobile strategy? How will they monetize mobile? If you look at their revenues, Q1 of 2012, it was 0. They've made massive strides. 30% of the revenues in Q1 of this year, 30%. So that's very impressive growth there. Twitter is already there. Half their revenues are from mobile devices. eMarketer believes it'll be over 60% in 2015. I think that's conservative. I think it'll be higher than that. And finally, mobile video. So YouTube, 25% of all the videos viewed on YouTube are already on mobile devices. Then you have the traditional carriers like Comcast. They all realize that the consumers want to be able to view the content wherever they are and whatever device they have. And therefore, they've really embraced the TV everywhere philosophy with Xfinity as Comcast play there. And if you look at mobile traffic, in 2013, over half of mobile traffic is video. And yes, some of that's because it's very data intensive. But a lot of people are watching a lot of videos now, but you can see the projected growth of mobile video in the coming years.
Speaking of video, our final trend that we want to talk about, and one that we have, and by the way, we have sessions today, breakout sessions on all of these items, because these are, the sort of hot button areas, is convergent, TV and digital video. If you thought of, the video Lumascape, that's all the digital guys, it's pretty fragmented, and still there's only about $3.5–4 billion of spend here. If you were to do a TV Lumascape, it'd be a lot different. Be a lot simpler. There'd only be one currency, Nielsen, and the players are different. It's a tight cabal. You've got Madison Avenue, you got the content creators, the packagers, and of course, distribution. So it'd be a very different looking ecosystem. And I got to thinking, hey, right now it's pretty consolidated. You've got the principles of the content on one end and the consumer on the other end, represented by the device, and all these layers in the middle of the channels, the media companies that package it, and then the delivery companies that send it to your device. And what's interesting is that this model is starting to see some cracks in the wall. We've had disintermediation by some of the distribution players moving straight to the channel, bypassing the media companies. We've also obviously seen a lot of activity right from the device, from the consumer, right through to either the media company, like Hulu and Amazon, or straight to the channels, like iTunes or Oreo, and even YouTube is taking you straight to content from the user, as is Netflix. And what's interesting is we now have a return path. We've got companies like Maker and Machinima and Big Frame that are YouTube channels creating digital-first content. Not only that, we've got the actual content themselves. Take, for example, Louis C.K. What did he do in his last big comedy show? He went straight to consumers, bypassing everybody in the ecosystem. So pretty substantial changes coming. And in addition, we've got the whole second screen phenomenon where in live events are being tweeted and tweets and tweets are being broadcast and events are tweeted, and then of course it creates a 360 engagement factor that people are taking, marketers are really starting to notice, and we will see dollars shifting there. So it got us thinking. You know, I spent the first half of my career helping big TV companies and broadcast and cable, and the second half of my career with digital, and I think the third half of my career is actually going to be spent with a lot of time, you know, in between these two. I think we're going to see a lot of sort of interesting convergent deals. So we're developing a presentation this summer called The Future of Digital Television. And it's actually not one presentation, it's two. So what we're going to do is we're going to go to the TV world and describe the digital, the players, the workflow, the economics. Then we're going to go to the sorry, we were going to do that for TV, because they kind of don't know about digital, and honestly, until now, they haven't cared. Then we're going to go to the digital world and explain the TV business, because they don't know it. They keep talking about disrupting TV dollars, but they don't know what they're talking about. Again, explaining the TV players, the workflow, and the economics. And then, ultimately, the ends of these presentations are the same. It's some of the issues in and around what happens in convergence land. And I will say that we're not doing this on our own. We're getting some help. Our friends at Simul Media and YouTube and Nielsen we're collaborating with on this cool presentation. We look forward to seeing that later this